It is 5:30 p.m. on a Friday. You have just finished a 45-hour work week. Your brain is completely fried, and the idea of cooking a meal seems about as appealing as climbing Mount Everest. So you order a $45 delivery meal, crack open a drink, and sink into the couch to binge a show you don't even really like, just to turn your brain off. You tell yourself, I earned this. I worked hard all week. But mathematically, that $45 order, plus the gas you burn driving home and the professional wardrobe you wore to get there, acts as a hidden tax on your labor. These costs are the price of admission for your own job. From the moment we graduate, we are sold a mathematical lie that our financial value is accurately defined by our annual gross salary. If you make $65,000 a year, that translates to roughly $31 an hour. On paper, it looks respectable. Yet, you might look at your paycheck and wonder where it all goes. You're processing more money through your bank account than ever before, but your savings balance stays completely flat. You're keeping almost none of it. If a bakery sells $1 million worth of bread, but spends $1 million on flour and rent, that business is worth zero. When you evaluate your career solely by top-line revenue, your salary, while ignoring the massive cost of selling your labor to an employer, you are effectively committing a form of personal accounting fraud. Let's run a financial autopsy on a hypothetical worker in this economy. We'll call him James. James makes $31 an hour, but before the money hits his account, government taxes take their cut. His hourly rate is instantly shaved down to $24. That is the easy math. Next, we deduct work-related costs, expenses paid solely for the privilege of keeping a job. The average American spends thousands annually on gas, car maintenance, and insurance. For James, that commute costs at least $4,000 a year. Then we deduct the appearance tax. James needs business casual clothes to look professional. Right next to that is the convenience tax. Because James is trapped at the office, he buys lunch, pays for afternoon coffee, and hires a dog walker. Finally, there is decompression spending, the money James spends to numb the psychological toll of the job itself. This includes the Friday night bar tab, the retail therapy, and the impulsive vacation he books simply because he needs to escape the office environment. Subtract these job-dependent expenses from his gross pay, and James isn't taking home $65,000. His functional net income is closer to $35,000. In business terms, his personal enterprise is operating on razor-thin margins. But wage is an equation of money divided by time. And just as we overestimate the money, we drastically underestimate the time. Human resources assumes a standard 40-hour work week. That ignores shadow work, unpaid labor dedicated entirely to the employer. James wakes up to shower, shave, and iron his shirt. He spends an hour every day commuting. None of this shows up on his timesheet, but it is time he cannot spend on himself. Even his 1-hour lunch break is captive time. He is technically off the clock, but he remains geographically restricted. He can't nap, he can't pursue a hobby, and he can't be with his family. He is effectively on standby for the company. When he finally gets home, he spends 30 minutes decompressing, venting about his boss or checking emails on his phone. His mental bandwidth is still being consumed by the stressors of the office. Compile the grooming, the commuting, and the worrying, and James's 40-hour week expands to 60 hours. This drastically inflates the denominator of his wage equation, devaluing every hour of his life. Now we do the real math. We take his depleted net income of $35,000 and divide it by his true commitment of nearly 3,000 hours a year. That $31 an hour evaporates. James is actually working for roughly $8.50. This reality creates a strange inversion. The teenager flipping burgers down the street often has zero commute-related debt, walks to work in a provided uniform, and stops providing labor the moment they clock out. Their real hourly wage often sits higher than James's. We see this most clearly during promotions. A $10,000 raise sounds like a win, but it often demands a more expensive wardrobe, a faster car to handle longer hours, and more frequent takeout to replace the time lost to the office. The higher salary forces an increase in overhead that can actually drive the real wage down. Corporate advancement often functions as a high churn trap. It keeps you spending your raises just to tolerate the new, heavier responsibilities required to earn them. The point of running these numbers is not to cause despair. It is to give you a tool for extreme financial clarity. Once you know your real hourly wage, your entire view of consumerism changes. $100 price tag represents 11 hours of sitting in traffic, answering passive-aggressive emails, and missing your family. When you weigh a purchase against the hours of life required to fund it, the impulse to buy often disappears. This mental friction immediately lowers your work-related expenses and stops you from trading your future freedom for temporary distractions. To break the cycle, shift your metric of success from gross income to personal margin. Your margin is the time and the money you have left over after the cost of working is paid. You can increase this margin without a raise. Negotiating to work from home 2 days a week instantly eliminates hundreds of hours of unpaid commuting and the associated fuel costs. It is a massive raise in time and capital that doesn't require a single extra cent from your employer. This Sunday, when you are fresh and rested, perform a brutal financial audit of your own life. Calculate your true wage. Write that number on a sticky note and tape it to your credit card. The wealthy trade capital to reclaim their minutes, while most workers do the exact opposite. To stop selling your life at a discount, you must build a gap between what you earn and what it costs you to earn it. That gap is where your freedom lives.